Welcome to the 12th Devmco Group webinar. Charles Thompson, and finally it looks like everything is going to be opening up on Monday, so quite exciting times ahead. Obviously back to work officially on the construction side from Monday, which is I think something we've all been waiting for, so that's good news. So today what we're going to be talking about is something that's come out of actually the demand over the last couple of months, during the lockdown and the discussions we've been having. It's going to be centered around buying off plan, as we've been talking about, key locations as we've been talking about, but more importantly, how do we use the current interest rates and why should we be buying off-plan stock that's available immediately? And it's something that's come out of sort of our grouping of tenants. We've got over 150 tenants that are occupying some of our existing apartments and homes, and also guys that are on the fence, wondering should they want to move into these secure estates, they want to move into the apartment type, easy listening, easy living, easy lifestyle, low maintenance, very convenient locations, but they're wondering, should I rent or should I buy? What are the pros and cons? So that's what we're really going to be talking about, coming out of a lot of the feedback that we've had over the last 8 weeks. So as it stands at the moment, with the interest rate cuts, typically, pre let's say COVID, everyone was talking about R1 million would typically mean about 10,000 Rand a month payment. With these 3.5% base point cuts over the period of the entire year, what it does mean now is that your 10,000 Rand a month on R1 million is actually more like 6,000 Rand a month on R1 million. And when you look at an apartment of 3 million Rand as an example, guys are paying sort of 16 to 18,000 Rand a month rental on that, but your bond payments are only about 2,000 Rand a month more than that. So a lot of clients or tenants have been chatting to me over the period of as I said, the last 8 weeks, and the advice is quite resolute in that, I've been telling guys, look, we've got a 2-year low interest rate window. We have to capitalize on that. Guys trying to get on the property ladder. We've talked about how the capital value of properties grow. The biggest hurdle or obstacle into entering the property market is that it's always been the rift between what you'd pay rent and what you'd pay in your bond, and that typically was anything up to 50%. So if you were paying 15,000 a month on rent, you'd have to pay 30,000 Rand a month on your bond. That obviously is reduced, and it's looking like it's going to be sustained for probably about 18 months to 2 years. So what that does is it means that you can get in, you can actually buy an apartment, and you can live there and pay maybe 2,000 or 3,000 Rand a month more than if you were paying a bond, but you're getting the capital growth. So once again, just going back to that 3 million Rand example, if we assume 7% growth per annum, which is quite conservative, you're making 200,000 Rand a year on your capital for a period of 2 years, 400, maybe even 500,000 on a unit. That allows you, that's a platform, so it allows you to then, either upgrade or re-gear your finance. What that means is, if your assets now worth 3.5, the bank will see it being worth 3.5 million, but you've only got, maybe let's say 2.5 million of debt. So there's enough equity to actually gear that, and maybe look at another property, or simply just stay in and just continue to pay it off. And the big difference with this, is getting onto the property ladder. A lot of guys, even investors, a lot of guys are a bit cautious in this time. Obviously, wanting to capitalize on these interest rates, and the good deal feel. Everyone feels that there's going to be some really good deals coming out on the back of this if you've got cash. But my advice is, I think I was on a webinar about a couple of weeks back, and one of the guys said, he was asked as a leading estate agent, when's the right time to buy, and he was told 15 years ago. So that is definitely the case. There's never a bad time to get onto the property market, even if you buy at a high point. Over time, your assets going to grow, and you're going to rectify any over purchases. That's not the case now. At the moment, we're hitting 50-year record lows on interest, buying off plan, low fees, no transfer fees. That's the stock that my advice as a property developer, or let's call it a property expert, would be to get in, seize this opportunity. It's not going to be a long window. I reiterate that I don't see this interest rate, let's call it below 8 to 8.5%. I don't see that being around for more than 2 years. Coupled with that, we've got, we're expecting to see quite large inflation. Maybe 6 months' time, we're going to see inflation starting to tick up. And what happens with property during that time is rental incomes also inflate, property values also inflate. It's the one asset that sticks with inflation, generally sticks quite closely with inflation. So you'll see large escalations in your property value. So the reason we're doing this webinar today is just to explain to the buyer out there. We've talked about buying in good locations. We've talked about buying off plan. And buying off plan is always a good idea. But what I'm saying today is look for developments that have got stock available immediately. There is no point buying now on a product that's going to be delivered in 18 months' time. Absolutely no point. You're not capitalizing at all on the interest cuts. And why I say that is you might qualify, it might be easier to qualify for the debt, but by the time you take ownership of that asset, the interest rates are going to stabilize back to the sort of 8.5%, 9%. That's what's going to happen over the next 2 years, and you've missed that gap. So currently sitting at 7.25%, we're expecting another probably 0.5% before the end of the year, and most buyers will get prime less a half. Most buyers will get between prime and prime less a half. That's sort of the area. So if we see another 0.5% cut, we're going to be at 6.75% prime, and we're going to see, and most guys will get probably a quarter or half a point off that. So you're really borrowing between 6.25 and 6.5%, and we see that being pretty stagnant for the next 18 months to 24 months. So my advice, and it's going to be a really short little snip today in terms of this topic, is find something that's in a good location. Guys, don't compromise on the location. Even if there's stock available in areas that the price is good and might be a good deal, the whole idea is to get into good locations so that you can see the capital growth. What that does over the next 2 years, and let's just stick with that 3 million apartment example, is it allows the capital to grow. You are servicing the same amount as if you were renting. Even if you're buying and your intention isn't to stay in the apartment or the unit or whatever you're looking at, your tenants will be paying the same rent you would be paying. So the differential between market rental and bond payments is so negligible at the moment. It's absolutely pivotal that guys jump in at the moment and optimize on this lower end so we can maximize capital growth. And that's generally what we've seen. Most investors, 20, 30-year-old investors that have been playing the game, over and over again, all started off by making smaller margins or capital growth, selling the assets, pulling out the capital, splitting that capital, buying 2 units, and so on and so on and so on. So that's the exact opportunity we find ourselves in at the moment. It is unprecedented that we've got these type of levels of interest, and I'm not sure whether we'll see these type of levels in South Africa again, maybe over the next course of our lifetimes even. As I said, lowest in 50 years. So that's really in a nutshell why we're saying find locations that are good, find locations that are close to your CBDs, close to all amenities, close to your hospital, shopping centres. Ideally in KZN you want to be beach proximity. Sea views are always important in terms of capital growth. Sea view products generally will see a 9, maybe even a 10% capital growth versus something inland. Obviously security, that's a non-negotiable in today's day and age. Facilities inside these estates, whether apartments or freestanding or duplexes, whatever, good facilities, well run, management associations that are obviously set up by developers, and importantly, trusted developers, guys that have got track records of developing and consistently developing and staying in and being available and dealing with problems. So that's what you need to be looking for. One of the comments that actually came out in I think it was last week was, with this COVID pandemic that's been going on, and obviously the high increase in use of these type of facilities, webinars and video conferencing and Zoom calls and whatever, we're going to see Joe Burgers, guys that are not living the lifestyles we are down here on the coast of KZN. We're going to see a lot of those families emigrating to the coast, enjoying the lifestyle, maybe flying up 1 or 2 days a week to do business there. But the bulk of the stuff can be done over webinars and through these these electronic forms of communication. So we're going to see that surge. Durban, particularly the north coast. When I'm saying this, from Durban up to the Ballito space, I really feel that's the, let's call it the golden crescent on the coastline. Once again, pay attention to micro locations. So nothing on the land side of the M4, everything on the beach side. That's where we're going to see capital growth. So I'll give you some examples of where I feel. I would say areas like Umhlanga Rocks. If you can get a good product, but off plan, don't be buying off a primary user. So you don't want to be paying your big transfer fees. You don't want to be paying your big estate agents fees. You don't want to lose 200,000-300,000 in let's call it sundry costs, because your capital is not going to appreciate on those numbers. Those are just wasted costs. So off plan, existing stock that's going to be ready in the next, let's call it 3 months. That's going to give you a really good run at getting this capital growth and not feeding a lot of money into it. Good location, micro location, so beach access, sea views, good facilities, good security, good fiber optic connections. So obviously everything's going to be on tech as we're talking about really good fiber connections. So that's where we feel that the surge is going to be. There's not a lot of that, so we know there's a lot of developers around, but who's got stock available? It's all great selling product that's going to be ready in 5 years' time. That's great vision and amazing, but that's not going to help us now. We need to find stock that's available that we can capitalize immediately. So that's really the gubbins of what we wanted to talk about today and push out. I'm just going to jump into some questions. With the interest rate having dropped, how long do you think it will remain like this for? So the banks are talking about another cut by the end of the year. They're talking about probably another 0.5% increase towards the middle of next year, and then a slow quarter, maybe another 0.5% increase towards the back end of next year, and then systematically, I think you're going to see 1/4 and 0.5% increases, getting us back to sort of the 9%ish, somewhere around there by say this time in 2 years' time, this sort of mid-year in 2 years' time. So all indications, and we've consulted 3 or 4 independent banks. They're all pricing in, quite a sort of flat line interest, a couple of dips, a couple of increases, and you can see that, and we can test that by looking at what they're doing with fixed interest rates. So a 3-year fixed interest rates, that's where you don't, your interest rate that you're paying isn't variable, so it's not linked to prime, it doesn't move up and down, it's stagnant. You pay a little bit more now for it, but it prices in what the economists are saying is going to happen over the next couple of years. And those fixed interest rates at the moment for a 2-year and a 3-year range between 7 and 8%. So that gives us a really good indicator on what the banks are seeing happening over the next X number of years. As a first-time buyer taking advantage of the low interest rate, what is the first step I should take to start this unfamiliar process? So, first step, identify an area. Identify a space that you're interested in. So, I mean, I'm a significant developer in the Sibaya area. So, get onto the Devmco Group websites, go have a look, see what you can find. There's pricing, there's modules, there's all those type of things that you can click on, see the units, see the sizes, see the locations, get a price, do your sums, work out how much that unit's going to cost me at, say, a 7% interest rate. Work it out. So let's go back to our 3 million example. 7%, 210,000 a year, divided by 12, and you get your whatever 16,000 rand a month, or 17,000 rand a month. If you were renting, you'd be paying 15. Okay, can you afford it? Yes, I can afford that. Then go and meet the agent. Go online, do a booking, phone one of the sales team. All the details are there. Get hold of me. I think my details on the websites. Come have a look. Make a decision. Go get your finance approved. Speak to your bankers. Use a mortgage broker. Our sales team can hand you over to a mortgage broker, which facilitate the process of getting finance. And get in, get stuck in. So even if if it's a buy to invest option that you're looking at, secure the unit. Ask the sales agent to please let your unit, because there's a big demand at the moment on in the Sabai area for letting. I don't think we've got any available units, but quite a large list of potential tenants. And get into it. So that would be my advice. Don't wait. I think the quicker the better. And yes, we know the transfer process is going to take a couple of months, but once you sign the paperwork, you've paid your price, you've got your stock, you've got your product, you can move them before transfer. You negotiate a deal with the landlord on your occupational interest, which is generally the same as what your bond would be, and get it going. Yeah, I think that to me is the crux. So over the next 4 weeks, I know as Devmco, we've got about 600 million rands worth of stock that on inquiries on stock, and over the next 4 weeks, our offices are going to be open 7 days a week to meet clients, walk them through. We've got all the facilities for sanitizing and isolation, and most of our meetings are open air meetings, and so those, it's actually very safe and able to be done. Most of the products are obviously open air outdoors, so and very small groupings. So my advice is don't wait, don't deliberate, get in and really take advantage. So going back to those numbers I was talking, we've got about 250 million rands worth of stock available at the moment, and we've got, as I said, 600 million rands worth of inquiries. So there's clearly a demand for existing stock. Speaking to other developers that have got 5-year, 10-year plans, not so much interest. And the reason that is the savvy investor or the savvy buyer that's been doing their numbers realizes that, hey, there's no point buying something that's going to be ready in 3 years' time, because the interest rates went back to where they were. So my advice is get on board as quickly as you can. Why do you think the north coast of KZN is performing so well, and why should I invest in property in this region? So good question, Megan. Main reason, lifestyle. Really great beach access, really close to, particularly I'm just talking about Sabaya, 5 minutes to the CBD. I think we're going to be posting something on the M4. I think the M4 is due to open in the next 3 weeks. They were laying surfacing yesterday, so that's probably even 3 minutes into Umhlanga. Very convenient, cheap in and out travel. You're not traveling from Belito to Umhlanga every day. The 30-minute in and out, the cost of that, the cost of your time, the cost of the fuel and maintenance of vehicles, all of those factors also play a part, because if your fuel bill is 1,000 Rand a month, as an example, living in Sabai, going in and out of work, versus 4 grand a month living in Belito, that's 3,000 Rand a month difference. I'd rather be putting that 3,000 Rand a month into my asset and seeing the capital grow. So those are some of the things that I consider when buying. Does Devmco have any products available in these areas around the 1 million range? So I'm not sure about 1 million, but there certainly are some products in the 1.3, 1.4 million range. I think there's a couple of those. I think there's a couple of 2 beds around about the 2.3, 2.4 million range. And when I say a couple, I mean literally 2 or 3. So yeah, those are really good rental stock. Those anything under 3 million, I'm a firm believer in that is the sweet spot in terms of buying to invest rental market. What is your impression of the demand for coastal property, taking into account the current economic situation? So I think I've probably had 25 discussions or 30 discussions with guys living in big, large homes in Durban North, sick of the maintenance, sick of cutting their lawns and cleaning swimming pools and sweeping tennis courts and repairing tennis courts. I'm talking about these large, opulent, old traditional 10, 15 million rand homes. Guys saying, I'm done, I want to lock up and go, I want facilities that I can use, I don't have to maintain, I don't want the cost of those maintenance, I don't want to pay a security company for alarm systems. I'm sick of shutting treadie doors and activating beams, and I don't want all that. I just want somewhere where I can have quality of life and convenience-based, simplistic life. And that's I think what COVID has really highlighted, and that's what estates offer. So yes, I think the demand, particularly on the coastal areas, is going to increase. It's going to continue to increase. And don't forget that we still sort of hovering in that 25 to 35,000 a square meter with, coastal property with CUs and beach access. You compare that to sort of Cape Town areas, that's threefold. You compare that to Umhlanga Rocks, probably half. So I think Sibaya is certainly the leader, and I don't think in the next 2 to 3 years you're going to see any properties under that 30